Okay. Well, welcome everyone. This is the Austin Women's Investing Group. This is our November meeting on my favorite topic of all time, the stock market. Just for those of you who are new to the group, we started back in 2014 just as a group of women who like to get together and talk about money and investing and finance. And since then, we've grown into a group of, at this point, like a few thousand members all across the country and even all across the world. But still at our core, we're a group of women that like to get together and talk about finance, investing, and money. So, one of the things that we want to encourage kind of across the board is, that this is the space to ask whatever questions you have, right? So beginners are welcome, more experienced people are welcome. And, we really try to kind of facilitate conversation as much as we can at these group meetings. So if you can use the chat box, or even if we have, I'm hoping we have time for plenty of Q&A at the end, because I'm assuming that people will have questions about what's happening in the markets. But definitely feel free to ask questions, answer other people's questions in the chat, because that's what this group is. Like, imagine us in a room at the Austin Public Library, sitting in a circle, sharing with each other. That's kind of what the whole group is about. If you haven't already, we kind of exist on two different platforms. Our main group is on meetup.com, and that's where all of the main invitations to the events come through. So please join us on Meetup if you haven't joined us there already. And then on Facebook, we have a private Facebook group where kind of some side discussions often break out, and people ask for referrals and resources and share cool articles and things like that. And then we also have a channel on YouTube where we've been, especially since March of 2020, we've been recording all of these meetings so that we can share them with the group, so that people who aren't able to be here, with us in person, are still able to share the content with us. So we will go ahead and record this as well. So maybe I'll have, Gwen, if you think it's a good time to start that, just let me know when we start recording, and then I'll kind of do the last little piece of disclosure language.
We are already recording.
Oh, perfect. Did you just record that whole thing?
Yes.
Oh, awesome. Good. Thank you. Wonderful. So it's like, oh, what should I go back and say again? Okay, so the last thing to say is, as always, nothing in this group is intended to be individualized investing advice. That's of particular importance to me because during the day, I am a financial advisor and the founder of Black Barn Financial, which is a registered investment advisor here in Austin. But when I'm here with the group, I am here sharing my opinions on the market, charts, data, ideas that I think are really important, but certainly nothing that I talk about or that anyone else in the group talks about should be construed as any type of investment advice. If you need personalized investing advice, reach out to someone, whether it's a financial advisor, or if you need tax advice, a CPA, or if you need legal advice, an attorney. This is just a place for us to share ideas and concepts with the group. So I guess without further ado, we will go ahead and get started. As we're going, I know that Gwen and Lori, probably know what slides are coming up and what information I'm hoping to at least start with tonight. But if you have a question, drop it in real time. And I think that if Gwen and Lori are looking at the questions, they'll either be able to stop me and say, hey, can we talk about this slide a little bit more, or kind of aggregate the questions so that we can talk about them at the end. So anything that pops up, just, feel free to ask the question, and we'll try to get to all of them before we wrap up at 7. Okay, so this is intended to be kind of an end of year bear market strategies discussion. We started off the year in January or February with a discussion about the stock market. And I think we all started off on a more optimistic note than maybe we've ended up on. So now that we're officially in a bear market, why don't we kind of go through and think about, some of the strategies you can use, some of the things to think about, some ways maybe to prepare for what might be coming ahead. And I'm just going to share with you kind of how I think about bear markets. And then again, we'll have plenty of time for Q&A at the end, hopefully. Lots of important information about this seminar. This is being recorded, so you can go back and read all of these in detail. The main ones are that this is not intended to be individualized investing advice. The other one that's really important whenever we're talking about anything investment related is past performance is not indicative of future results. So as many of you have heard me say time and time again, when we're thinking about investing and finance, that is forward looking. We're trying to make forecasts or predictions about the future based on the information that we have right now, which is obviously limited to the information we have right now. So we do tend to look to the past and try to find information that can help us make decisions about an unknown future. But obviously the future is not going to be exactly like the past. It might be similar in some cases, but there's almost always going to be some pretty major differences. But we're just trying to do the best we can to make investing decisions going forward. Here's a whole bunch of more, disclosure languages or disclosure bullet points that you can take a look at when you get a chance. Here's a little bit about me. I'm not going to spend too much on this slide. Definitely feel free to, send me an email, find me through the Austin Women's Investing Group, find me through Black Barn Financial, find me through the Women on the Verge of a Financial Breakthrough podcast that Caitlin Meredith and I started last year. So there's lots of different ways, I think, to probably reach out and learn more about me personally. So I won't spend too much time on that as of now because we have limited time together. Okay, I love this quote. The greatest antidote to fear is preparation. Definitely one of the things, maybe even the prevailing emotion that comes up during bear markets is fear. I don't know, maybe for some people that has kind of morphed into panic. For other people, the emotion that bubbles to the surface is, somehow excitement or kind of this feeling of opportunity. But definitely, I think the emotion that I'm approaching this from is that fear and panic and despair are definitely our biggest enemy during a bear market. And being able to put those emotions into context and make good financial decisions often means figuring out how to manage our fear. So that's how I'm approaching this. A little bit about bear markets. I will stop for just a second and tell you what a bear market is, because many of you may have questions about it. The term bear market, when we use that, it means a 20% decline in prices. So if we're talking about the stock market, at the beginning of the year, the S&P 500 was at 4,800. Today, we're at about 3,900. Is that still in a bear market? I'm going to do the math. Let's see, 39 minus 48. Divided by 48. Okay, so that's a 18.75% decline as of today, but we've been lower than this through the year. So we'll just say that this year we've been in a bear market in stocks. So it's just this term that describes the idea of a price of something falling by 20%. It's not unique to the stock market. Housing markets can be in bear markets. Bond markets can be in bear markets. Crypto markets can be in bear markets. It's just this idea of a 20% decline. The other side of a bear market is a bull market. That's when prices go up by 20% or more from some starting point. So here's just a few facts about bear markets. I put the source down here on the slide, so definitely check out this. It's like a little one-page list of bear market facts that Hartford Funds put out that I think is really useful. So in bear markets, prices drop, in bear markets in the stock market, prices drop about 36% on average. So that's a pretty big decline, especially if you kind of got used to over the last several years, the stock market kind of steadily chugged up. We had, the terrifying bear market in March of 2020 that kind of quickly reversed itself. But 36% decline is a pretty big decline. It's enough for most people to notice it and feel it and be worried about it. On the other side, bull markets typically gain 114% on average, right? So if you look at a long-term chart, which of course we will, you'll see that we have these relatively short but dramatic declines in prices, and then these relatively long increase in prices as the economy kind of falls off a cliff maybe, and then recovers, and then falls and recovers. The average bear market lasts about 289 days, and the average bull market lasts almost 1,000 days, right? So again, this idea that bear markets, part of what makes them so difficult to get through is they're pretty intense, right? They're short and severe typically, whereas bull markets tend to kind of mosey on upward over long periods of time. Some other kind of interesting facts: over the last 20 years, half of the S&P 500's strongest days took place in a bear market. We have seen some pretty dramatic one-day rallies this week, the end of last week and this week, where the stock market kind of pops up by 2, 3, 4% in one day, right? And if you get a couple of those days back to back, all of a sudden you're not in the bear market anymore. You go from the S&P 500 being down 25% to only being down 19%, and that can happen over the course of a few days. Within the same time horizon, 34% of the market's best days happened within the first 2 months of a bull market. One of the things that may not be obvious, but may be intuitive once you think about it, is nobody knows when the bear market is over and when the bull market has begun, right? Like, you will not know until it's already happened and you're looking back at it, which will definitely feed through into, okay, well, knowing that, what are some of the actions that we can or should be taking when it comes to trying to navigate bear markets. If you're investing over a 50-year time horizon, which hopefully most of us are, your portfolio can be expected to go through about 14 bear markets, maybe a few more, maybe a few fewer, but that's a lot of bear markets. So we may as well kind of get used to it and have strategies in place for how to weather them. And over the last 92 years, stocks have spent the vast majority of the time, 78% of the time, they are not in bear markets. So most of the time, the stock market is not down 20% from all-time highs. Most of the time, it's within all-time highs or reaching all-time highs. So I think that's important to know too. It can feel like, at least for me, it's feeling like this year is dragging on forever, and then we're talking about what might happen through the end of the year or into next year, and it's like, oh my gosh, is this ever going to end? But the answer is, yeah, it will. We don't know exactly when, but most of the time, the stock market is trending upward. So a couple of things I'm going to talk about. I think I have slides and charts for a lot of this stuff. Some of these are market specific and some of them are not, right? What are some of the things that we can be doing? First, don't panic during chaos, right? That's the first part. How do we make non-emotional decisions when we are feeling scared? We're going to talk about remembering stock market basics. So going back to, what is the stock market? Why does it act the way it does? And how can we use that to our advantage? Dig deep to find your real goals. This goes back to tying in the financial decisions that you're making to what you're trying to achieve. Start an investing journal. I think that that's always really helpful to get your thoughts down on paper. Building a supply of cash and cheap credit. That could end up being very important going forward. So we'll talk more about that. Evaluating the things you're holding with fresh eyes now that we're kind of in the middle of the bear. Revisiting asset allocation. So revisiting how much risk you are taking right now, and is it appropriate for both your financial goals and your risk tolerance. This idea of maybe buying dips and or selling rallies, depending on what side of the spectrum you are falling on. And then doing all of this work and letting it go, letting the market do what it does, and really coming to peace with the things that we control and the things that we can't control. So this is kind of our roadmap for today. Any questions before I start? Okay, just stop me if anything pops up.
All right, first question, Sarah. Sarah, this is
yeah.
Caitlin. I'm sorry, I didn't put it in the chat because I can't type very well on my iPad. If there have been 14 of the, if like there will be 14 bear markets in most of our financial lives where we have like money that is affected, why are we freaking out? I guess I can understand that, but like, why isn't the system more like, yes, this again? We know how this works. Like, it's taken like it's like earth-ending news, and like we have no idea how this will play out.
Yeah.
But if it happens 14 times in most people's financial lifetimes, like, what's the disconnect?
Yeah, I mean, I think that it comes from, I think that most people are kind of in the camp of like, here we go again. Man, we just did this in 2020, and then we did in 2018, and then we did in 2016. Oh, and then there was like 2011. Remember, you remember Grexit before Brexit? Like, oh, and then we had 2008, 2009. So I think that most people are actually approaching it like that. But the people who get the most airtime and the people who are selling ads and selling magazines and newspapers, it's not very sexy headline. So you have a lot of news cycles to fill, and a lot of people have to get paid, and a lot of airtime, needs to be filled. So I think kind of this creation of like, this time is different. This is, everything's going to change. This is going to wipe everybody out. Like all of those things come up every single cycle.
Yeah.
So, I mean, I guess, I don't know, like maybe it could be true, right? But if we look back through history, it hasn't happened before, and a lot of bad things have happened before. So that's a good question. But I don't know.
Just dummies like me that are like, this never happened before. Just my luck. The one time I'm alive, this happened.
Just when you started. That's right. Really good question. Okay, so kind of on that note, whether this is your first bear market, which, for a lot of people it is, right? This is like the first real bear market where it's kind of gone on for a long time and it doesn't seem to be resolving itself. If this is your first bear market, like the key is to not panic during chaos, right? I have in here, this is a little bit, maybe a little bit too late to be helpful, but learning as much as you can before a crisis hits is helpful, right? Like if you've been part of the group before, I think whenever we're talking about the stock market, we're talking about like, well, you better be ready. Like it seems good now, but it's going to get rough. And then it finally, really happened in a pretty extreme way this year. So like understanding that these are going to happen time and time again for different reasons is important, because it's good to have a game plan before the bear market hits, so that you can anticipate what you're going to feel and then anticipate what you're going to think you should do and then figure out if that's actually the thing you should do. If you're afraid of taking too many risks, it's much better to change your plan pre-crisis, not mid-crisis. I would say we are now officially kind of mid-crisis. So it's not the best time to be changing your plan, but it still might be appropriate to do so. Like along those lines, if you take risk off the table after prices fall, you are almost certainly, maybe not exactly certainly, but you may be locking in your losses. So that means you bought something at $100 per share. It falls to $75 per share. You sell it at $75. Now you've locked in that $25 loss, or that 25% loss. What do you do next with the $75 that you have left over? If you don't reinvest it, then you have no chance of making that money back. But maybe if you do figure out a way to reinvest it, you can earn it back. This is a big one. It kind of goes, I think, to Caitlin's question, like sticking to evidence-based, data-backed strategies is important because the whole financial industry, it kind of revolves on this fear and greed cycle. And that's really important to know, that a lot of people are trying to sell you something, right? Just like with everything in life. But that fear and greed cycle is monetizable in the financial markets. And there are a lot of people trying to do that. So if you can try to avoid the narratives that are playing to your emotions, you'll probably have a better chance of kind of navigating this and making good financial decisions. And then KISS, keep it simple, shareholder. You don't need to do a lot of fancy stuff to make it through bear markets. A lot of what needs to happen is controlling emotions more than anything. And that is something that we can all kind of work on ourselves. And we don't need fancy hedging strategies or fancy financial products or complicated products in order to do that. So if we're going to look at the basics of the stock market, this is a chart. Those of you who have been a part of the group for a long time know that I put this chart up every single time I talk because it's my favorite of all time. And so what we're looking at here is a chart showing the price of the S&P 500. So when they say the S&P closed at 39.42 today, that's the white line. And the gold line is showing earnings. Another word for earnings is profits. So this is how much money did the companies in the S&P 500 actually generate, over this time period from 1988 until basically the present. So we can see here that most of the time, the price of the S&P 500, so the price of the stock market, pretty closely correlates with earnings or the amount of money that companies can generate. We have, it's not perfect. We have back here this instance where the white line went way above the gold line during the dot-com bubble. So this is when, kind of the internet took off. All types of internet companies, everybody kind of got caught up and got really excited about the internet. The problem was that those internet companies didn't really know how to make money yet. And so profits never caught up to the price. And that's what a bubble looks like. And the price of those companies fell until that relationship between price and earnings kind of matched up again and went up just in time for the financial crisis, where instead of there being a bubble in stocks, there was a bubble in housing prices. People stopped paying their mortgages. Bank profits fell off a cliff and went negative, and earnings came down really fast, and the price of the stock market came down really fast. We had those two crashes for two different reasons happen in relatively short order during the 2000s. And we kind of have this recovery where you can see the gold line is profits of companies going up, but the white line of the stock market not really keeping up there. And this is really showing that after the stock market crashed twice, starting in about 2009, people were not interested in the stock market anymore. They were scared. They had been burned twice in 10 years. So it's understandable why a lot of people were scared out of the market for a while. But it took a while for the price of the stock market to catch up to the health of the companies that make up the stock market. And then we kind of have this relatively close correlation between earnings and price until the pandemic, right? So you guys know, we did, I showed this chart during the pandemic, and we were trying to figure out how far profits would fall. I mean, the answer is they ended up falling this far, where the gold line is now. And, we recognized in real time, we could see this chart that the white line pretty quickly started pulling up and away from the gold line, right? The price of stocks was getting ahead of the earnings. They were anticipating the earnings from the post-pandemic period. The price went up to 4,800 at the beginning of this year. And since then, we can see it has very sharply come down. And this is, basically where we are today. So if I'm looking at this, it's interesting to see that, sometimes the stock market can be running behind, sometimes it can be running ahead of the health of the companies in the stock market. But this is the fundamental underpinning of why the stock market works the way it does. It's reflecting the financial health of the companies that you own when you own stocks. So everybody's now looking forward, and we're trying to figure out, okay, well, if this is the gold line, which is basically what profits have been, we don't necessarily care about that anymore because it already happened. Now everybody's trying to figure out what profits will be in the future, because that should show us what direction the white line is going to go. So these boxes here, 2022 and 2023, are forecasts from Ed Yardeni. You can go to, I can't remember the website, but if you just Googled Yardeni earnings, he publishes his earnings estimate every week. It's really easy to follow and it's free. But Ed Yardeni says, like, okay, we think that 2022 earnings will be about $215. And next year, we still think that profits are going to grow, and maybe profits for the S&P 500 will come in at about 235, I think are his estimates. Now, these are big ifs, right? If anyone has been paying attention to anything in the financial news, you know that we are anticipating, expecting, almost like guaranteeing at this point, a recession, right? If there is a recession, companies will not be able to make as much money as is projected here. And if earnings come in down, down much lower, if there's a recession, then we would expect the white line to follow lower. So this is like what makes the year-to-year projections about what is happening in the stock market so challenging. Like, are we all going to sit here and try to forecast earnings? Probably not, right? From year to year, earnings are dependent on the interest rate cycle, the inflation cycle, the business cycle, consumer confidence, business confidence. All of these things are working together, not just in the US, but globally, to those companies are working in that environment in order to try to generate profits, but trying to predict how profitable companies are and when they are profitable is really, really challenging. That's why in the short term, the stock market can do a lot of wild stuff. So I'm going to stop here for a second because people often have questions about this chart. And if there are any questions, I am happy to stop here for a minute. No? All right. I'm going to keep going then. And we can always come back to it.
Wait, okay. Sorry, I do have a question. I wasn't going to ask if other people had it, but so I live in the Bay Area now, and like half the people I know either lost their jobs or thought they were going to lose their jobs this week, because of the big movements in tech. And I'm wondering if that's directly correlated with these losses. I know this is a little side thing, but did the tech companies just wake up and look at these numbers and they're like, abort, get everybody off this boat? Or is that a parallel process?
I mean, they are related, right? So for tech companies, especially, because they've been in the news about this. This year in 2022, when big tech companies reported their profits, they reported generally speaking, they reported lower than expected profits. And part of that is that consumers, aren't necessarily feeling awesome, so they're not maybe spending as much money. But the other huge piece for tech companies is that they overhired. You remember like the hiring spree from earlier this year and last year?
Okay.
When
yeah.
Every person in tech was switching jobs and, doubling their pay. Tech companies were really aggressive about hiring, so their expenses went way up. So if you think about, like, there's money coming in, that's revenue. There's money going out, which are expenses. And then whatever is left over is your profits. So tech companies in particular had too many people and weren't generating enough money from sales. So they have been relatively aggressive about laying people off. And while that's not good, certainly not good for the people being laid off, obviously, if you're the owner of the company and you think, well, if expenses go down, if we're able to keep the same amount of revenue and pay fewer people, there's more money left over at the end, which is higher profits. So certainly, like, employment and unemployment and profits are often in conflict with each other, right? Because payroll takes money away from profits. And so companies are always trying to balance those things out.
I gotcha.
And now in the US, tech companies are disproportionately a large part of the S&P 500. So when tech reports low profits, the whole market suffers, for sure. So that's a really good question. Okay, I'm going to keep going. So we're continuing to talk about the stock market. One of the things that it's easy to forget when times are good is that the volatility of the stock market, so the day-to-day price swings of the stock market, it generates something we call the equity risk premium. That's the extra return that you should get over long periods of time for taking the risk. If you look over long periods of time, and I have some charts, over long periods of time, you see the difference between, saving in cash, investing in bonds, and investing in stocks. You get relatively high rates of return by taking risk. And it's specifically by taking risk when it's risky instead of when it's safe. If you think about the way the stock market works, if you wait until, look at all kind of the all-time highs as we're going along, if you're always waiting for all-time highs to feel good about investing in the stock market, you're getting relatively close to the time when the stock market corrects, right? The market goes up and it goes down. It goes up and it goes down. So if you wait for it to go up before you invest, you kind of miss the whole point, the whole upswing of it. These gold lines are showing daily price movements in the stock market. I mean, in this gold one, this 12% gold one, it was pretty dramatic. That was in March of 2020. We had a couple days, several days, where the stock market fell by so much that it triggered these circuit breakers where they stop trading on the stock market so that everybody can chill out and collect themselves. A 12% move in the stock market in one day is a lot. It's not the most ever. The most ever was in October of 1987 when the stock market fell 20% in a day, but 12% in a day is a lot. So when you get these dramatic daily price movements, it adds to that feeling of uncertainty and risk because it's scary. Most of the time when you have these daily price changes of this magnitude, it's to the downside, right? It means it falls by 12% or 4% or 3% in a day, and that could be really scary. But the reason you get higher rates of return over long periods of time is because you are invested during these risky times, or maybe even adding a little bit of money in there during these risky times. That is intuitive to people when the market is going up, but it's not intuitive when the market is going down, right? It feels like we got to get out. We can't do this anymore. But it's the investing part, if you're in it for the long run, is actually the opposite. Any questions on this? All right, let me keep going. The S&P 500 versus recessions, right? Recessions and bear markets are different. The bear market is describing the prices of stocks in this case. Recession is describing the state of the economy. So think of a recession as when people lose their jobs and GDP goes negative for some period of time, maybe 2 quarters, 3 quarters, something like that. So it's a slowdown in the economy. Bear markets are just when the price of something falls. So bear markets have always accompanied recessions, going back to like, okay, if the economy is slowing down, then we do expect the profits of companies to fall and therefore the price of companies to fall. But recessions have not always accompanied bear markets. For individual people, I like to make this distinction because for most people, the real risk is that you lose your job, right? The real risk is not actually the bear market. It's that you lose your job and you don't have any money saved up. And now you have to sell your stocks in the middle of a bear market in order to pay the bills. So you can mitigate that risk by having your emergency fund or some safe store of funds available if you lose your job in a recession. So those are slightly different. People tend to think of them as the same, that the bear market itself is the risk. But for most people, it's much more severe to lose your source of income than to experience either a temporary or even an extended period of time where prices are less than what you paid for them. For the reason of the slowing down of the economy and recessions, dramatic stock market declines are associated with recessions. Because again, earnings typically fall when recessions, earnings typically fall when the economy contracts. But the other thing to note is that typically the stock market bottoms or it reaches its kind of lowest point before the recession resolves itself. So there's not a perfect timing. The recession doesn't start when the bear market starts, and the recession doesn't end when the bear market ends. They are two separate pieces that are related to each other, but not the same. So if we go back to being on recession watch, these gold boxes are assuming, first of all, they're assuming we're not in a recession right now. And they're assuming that we're not going to be in a recession next year, which is a pretty big if, right? So I just kind of wanted to point out that if we do go into the most well-telegraphed, anticipated, and expected recession that any of us will probably see, there's no surprise to it, right? If we do go into it, then the stock market will probably get worse before it gets better. So then the question is like, are we in a recession? Are we near a recession? This is the Atlanta Fed GDP Now forecast. So GDP stands for gross domestic product. You can kind of think of it like adding up all of the goods and services that are sold in the US. If GDP is growing, then businesses are growing. If GDP is falling, then businesses are getting smaller or businesses decreasing. So you can download this app on your phone. I just got an update today when they updated the GDP Now estimate, but they'll try to tell you in real time if the economy is growing or shrinking. So what we're seeing here, the blue chip consensus is the average of the forecasts for how fast the US economy will grow in the fourth quarter. And you can see here that most economists think that the economy will grow by, what is this, like 0.5% this quarter. The forecasts that the Atlanta Fed is measuring is saying that the economy is going to grow by over 4%, like on top of inflation. It's also a real GDP number. So 4% on top of inflation this quarter, which is not what people are feeling. People keep saying we're already in a recession. We're on the verge of a recession. This is saying we are not, and we're not even close, right? Over 4% on top of inflation is how fast our economy is growing right now. So this is saying no. But if we look at one of the other economic indicators, this is actually the Conference Board Leading Economic Indicator Index, and it gets published monthly. The leading economic index is saying we might be on the cusp of a recession. So here you can see that this blue line is the leading economic indicator. And down here you can see the 10 components, and you can look at the methodology if you're into that type of thing. But you can see that this blue line tends to start turning over going into a recession. So it tends to be like pretty predictive of a recession. It's not perfect, right? Back here in 2015, 2016, you can see the leading economic indicators kind of flatlined and went sideways, but it didn't actually really turn over. This is showing that this indicator is rolling over, which looks like it's forecasting recession. But these two charts are in direct contrast to each other. Yeah.
We've got a question from Lena who says, I wonder, is it a lagger indication?
All of these are meant to be leading economic indicators. The other line here, the what is that, brown grayish line, is the coincident economic index. So that's supposed to be in real time. So if this, at least in the past, this indicator has not lagged a recession, if that makes sense. I suppose like it could, but all of the components of the leading economic index are meant to be the way that people, investors, and businesses are acting in anticipation of a slowdown, not once the slowdown has happened. Does that make sense? And I will say that, like number 7 down here, one of the components is the S&P 500. So the stock market is one of the leading economic indicators because most of us believe that the stock market is forward-looking, right? And trying to be predictive of what's happening in the future, not what happened in the past. Did that answer that question?
Yes, thanks. That helps a lot. Thank you.
Yeah. We did have negative GDP. I think we talked about this in the summer. We did have negative GDP in the first quarter and the second quarter of the year, but almost no one believed that we were actually in recession. One of the really important indicators of recession is the unemployment rate. And we just do not, we still have very, very low unemployment. So if the economy is shrinking, then people should be laying off even more aggressively than they are. It might seem like they're aggressively laying off, but they really aren't because our unemployment rate is still really, really low. That's actually one of the things that would probably confirm a recession is if you have negative GDP and rising unemployment, but it's just not happening that way right now, which is very confusing. These are very confusing times in the market, I will say.
Hey, Sarah.
Yeah.
Do you know the current unemployment rate just off the top of your head?
It's something like 3.5. Am I right? Does anyone want to Google that? I feel like it's 3.5 or 3.6.
3.7.
And one thing I noticed when looking at this chart is that when the recession is shown on the chart, it can be at different points of that downward curve. So even though it's starting to go down, that still doesn't tell you, well, one, if a recession is coming, or two, like when would it happen?
Right. I mean, and if you think about the way that we experience recessions, like, again, like come back to how does a recession impact you personally, right? For most people, it is losing your job, right? And that's, that you could get laid off at the beginning of the recession, you could get laid off at the end of the recession, right in the middle of the recession. But if you have some idea that it's coming, you at least have time to prepare, right? Time to put in some extra time at the office or like get a backup plan in place. You don't want to be caught unawares in a recession without having a bunch of resources to pull from. But you're right, Lori, because like by the time the National Bureau of Economic Research, they're the ones who look at the data and kind of retroactively tell you we were in a recession. So kind of going back to the lagging indicator question, the LEI is supposed to be a leading indicator, but by the time you're in a recession, you're already in it, right? Like no one declares recession at the moment that's happening. They only know in retrospect that, oh, it happened last quarter. We had negative GDP and unemployment spiked to 5%, right? Or we had negative GDP for 2 quarters and inflation spiked. So there's kind of all of these factors that go into it. And then someone will be like, oh, yeah, we're officially in recession. That doesn't stop people from saying we're in recession or feeling like we're in recession, because that can be subjective. But if we're just talking about like the actual term, I think we talked about this on one of the podcasts, right? That often too, like whether or not we're in a recession, like kind of the way it directly impacts people is like certainly like if you lose your job or your industry is struggling, and if it's the political party that you are not in favor of, right? If it's like, can you blame the other political party for being in recession? That is often like a powerful way that the term recession is used, and and kind of becomes a much more important term.
And that by the time someone like me knows about it, like it's already happened. And so there's nothing really I can do differently or whatever. Like it's what happened to Sarah?
I'm still here.
Oh, are you good?
Sorry, my light went off. I wanted to turn it back on so that I wasn't sitting in the dark.
Oh, it's the motion detector light.
Yeah.
You're too still. Yeah, that by the time we know about it, it's old news. And
Right.
There's really nothing we can do about it other than go back 12 months and really saved up our emergency fund so we have something in case we lose our job.
Right. So for me, again, like, okay, how can we use this information? It's this, like the recession talk should not take anyone by surprise. Everybody's been talking about it for the entire year, really, right? Certainly, like it keeps getting more and more, maybe the recession is getting closer and closer. And so you still have time to prepare for that unfortunate event where, is your income at risk, right? I think that that's really important and mostly overlooked. We mostly think about recessions in terms of the stock market, but the job piece is, for most people, the most important thing. All right.
So Sara, this is kind of off topic, but sort of goes with it. So I heard today that they officially declared a recession in the UK, and they said that households are not earning as much as they used to. They said it was a record fall in household income. So
Yeah.
To me, that kind of, I know it's a separate country, but everything's so global these days that to me, that kind of implies that the US might be headed the same direction. What do you think?
Yeah, I mean, so that's really interesting. I know that the UK just had an even higher inflation print than we did. So they have a lot of inflation. Some of that is like the energy situation in Europe, right? And some of it is Brexit related. Remember that the UK said they didn't want to be a part of Europe anymore, and that's expensive to be a little island, right? Everything costs more if you don't have trade agreements with the people who live next door to you. So some of that is like self-inflicted pain that now they're muddling through. And so if you have really high inflation and incomes don't keep up, then you could have like that record decline in real income, right? Like, okay, inflation's at 11% and my wages went up 3%. That's negative 8% income when it comes to what you can buy with your income. So definitely like everything is global. And there are very specific problems in specific parts of the world that the US is insulated from in a lot of ways. But like if you think about the large economies, like, okay, if they slow down by enough, do they drag the rest of the world down with them? Really, I would say like the biggest economy that does that is the US, right? Like, what if the US sneezes, the world catches a cold, I think is what they say, right? Like we're still the biggest, we're still the most powerful economy. We're also still like pretty flexible with the way we deal with economic downturns. We have a lot of tools in our toolbox. We have a lot of resources. We have lots and lots of money that we can deploy in different ways. But that doesn't mean that like a slowdown in other parts of the world does not impact us for sure. But I would say like the UK is kind of, a lot of people like throw around the word perfect storm, and I'm about to do it too, right? Like the UK is kind of in a perfect storm type of situation too. Partially their own faults, partially, or maybe not even their faults, just like, this is what you voted for, right? Like higher prices and things. So now it's here. And partially, out of their control if there is a global slowdown for, whatever reasons, pandemic related reasons, war in Ukraine, whatever they are. That's a really good question though. All right, cool. All right, let's keep going. We can definitely come back to this too. And again, like I tried to put all of the links and places you can go to get this information on your own. It's all public information. Oh, I just wanted to throw this in here because we just had the midterms. I know it's a little bit old news, but I thought it was interesting. So this is the S&P 500 and midterm elections. So the green bars are midterm election years. I just want to go through here because I did it right before the meeting. This goes all the way back to 1951. Look at the 12-month return after election years for every single midterm year. If you look at the 12 months, so the next 12 months performance after the midterm year, the next year S&P 500, I think every single one is positive. Ooh, 1986 is barely positive, but all of these are positive. Isn't that interesting? That's not a prediction and it's not investing advice, but I do think it's interesting. Now that we have like the election is behind us, we have 2 years of relative calm before the next election, right? Maybe people will chill out a little bit, but maybe the market could recover over the next 12 months. I don't know, but I just thought that was interesting, so I threw it in there. And then kind of coming back, talking about inflation, that is definitely the main theme of 2022 is inflation. So this goes all the way back to 1965, showing the yearly percentage change in the consumer price index. So you can see we've had lots of periods of time where we do have spikes in inflation. Here's kind of our most recent one. The headline inflation numbers, which include food and energy, is the blue line. And then the core CPI, which excludes food and energy. You can just see how, just in 2022, we've just had this gigantic spike up. What everybody would like to see, if you're an investor, what you want to see is this blue line and the red line trend down, right? This has just been killing the markets. It's been killing the bond market and the stock market. It's just too high. It's very unpleasant. And so can the economy figure out a way to better match up supply and demand? We've obviously had supply problems with the war in Ukraine and with China having COVID-0 and with our own, pandemic related mismatches between supply and demand. We just have people with money who want to buy more stuff and do more things than we have supply of that stuff. But over time, there is a way that supply demand mismatch could work itself out and maybe those prices will start coming down. That's what everybody's hoping for. We will see, right? They announced the CPI I think it's at the beginning of each month. So they just announced the October CPI. It came in much lower than people expected, and the stock market took off. I think the NASDAQ went up by 4% that day. That CPI numbers came in lower than expected. And it was the first time they came in lower than expected kind of all year. So that's going to be a big driver of how people view the markets. It's really hard to make decisions when you don't know what the price of something is going to be in the near term, right? If you don't know how much Thanksgiving dinner is going to cost, there's just way more uncertainty around that. If you don't know how much a used car is going to be, it's really hard for people to make decisions, and it's hard for the economy to function. And then here, if we go back to the stock market, I mean, I know this is, it's going to sound ridiculous, like during this year when the stock market has been so bad and inflation has been so high, but over long periods of time, the stock market actually gives you a rate of return on top of inflation over long periods of time. So what I'm showing here, the red line is the total return index. So the total return from your stocks going back to 1935. And here you can see this red line, it's kind of in this 10% band, right? So it's about 10% per year on average over this really, really long period of time. And that, I think I've said that before, in meetings, like, the stock market tends to average 9-10% per year. And then if you want to adjust that for inflation, you look at the blue line. So if you took the rate of return from stocks and subtracted inflation, your rate of return is still 6.5%. So that means it's 6.5% on top of inflation. If you think about cash at 0 or 1 or 2%, there's no chance you're going to beat inflation with cash, right? That's why we all know that holding cash during times of inflation over long periods of time you're going to lose purchasing power. But stocks, because companies have this ability to increase prices for their goods and services, lay people off, reduce their expenses, be really creative with their debt financing, companies are clever enough to figure out how to make profits during or in all types of economic environments, disinflationary, inflationary, normal, abnormal. And so eventually the stock market works itself out, and over long periods of time has given you a 5, 6, 6.5% rate of return on top of inflation, which makes it a good inflation hedge over long periods of time for those of you who are concerned about inflation. It's another reason to not give up on stocks, even when it's grim, because where else are you going to get inflation protection? Any questions on that? I think I showed this slide last time, but I just wanted to show it again. Okay, so I spent a lot of time on the stock market basics. Some of these things were basic, some of them were not basic, but just a reminder of kind of how the stock market works. Now, if we're thinking about, okay, well, what can we do to get through this bear market that we're in real time? I always find that it's really, really helpful to figure out what you are really trying to do. And the reason I say that is because if you're not clear how you need your money to work for you or how you want your money to work for you, you don't really have a good basis from which to make decisions, right? Like, it's really easy to say, I just always want to make money. I just always want my investments to go up. That's not ever going to happen, right? So we just need to cast that aside. Some people already have enough to fulfill their needs for the rest of their lives. And those people probably want their money to be safe, right? I already have enough. I don't need to take a lot of risk. So why would I, right? Those are the very rich, right? And sometimes that's also the people who are not rich enough, because the feeling is, well, this is all I have. Even if it's not enough, I want to keep it safe, right? On the other side of the spectrum, where most people are is, okay, I have X number of years to build a nest egg large enough where I can have a secure retirement. Or I'm getting close to retirement, but I'm expecting to live a long time. I'm expecting to have a long retirement. I need that money to grow faster than inflation so that inflation doesn't eat me alive when I'm in my, when I'm in my 80s. So if you can tie that back, then it can lead you to the investing goals, right? If you have short-term goals, that money is not for the stock market. We do not know what the stock market's going to do in the next year or 2 years or 3 years. So any short-term money should be in cash. Midterm money, which is for a lot of people, college, for kids, that's probably a mix of something like stocks and a mix of maybe cash, maybe bonds, something like that. But those long-term goals where you have a relatively long runway and you don't need the money and you need it to grow, that's where the stock market as a wealth building engine comes into play. So I don't have any time value of money calculations in this slideshow. I know we've done it a bunch of times. I think we have videos, and Caitlin and I did a podcast on time value of money. So if you want to learn more about how to calculate the rate of return you need to get to an endpoint, like a certain nest egg, is it $1 million? Is it $500,000? Is it $10 million? Whatever it is, you can use time value of money to figure that out. But just kind of thinking about things and like, well, I had $200,000 at the beginning of the year, and now I had 160. I really should get out of stocks. It's not enough information for you to be making those choices, right? If you know you need the 160 to pay for something, some expense that's coming up really, really soon, then maybe it is the right choice. But if you were originally trying to get that 200,000 to $1 million, you need it to be in stocks for the long run. So figuring out what those real goals are is really important. Building a supply of cash and access to cheap credit. This, again, this comes from like that recession preparation. Also, a lot of people have a safety blanket amount that they just like to have in cash. It's a way to protect that long-term investing strategy. And I will tell you, this has been vital, like to the clients that I've worked with and the people I've talked to, where I've had the vast majority of the conversations I've had this year are, yeah, it sucks that the market is down. I'm in it for the long run, and I have this amount set aside in cash. We're going to be okay. Because a bunch of people did that work ahead of time. They built up that cash reserve. They put these pieces in place ahead of time so that we don't have to talk about whether we need to sell stocks, at a 20 or 30% decline. So it's really important. How much do you need? It depends. This is like the old emergency fund conversation. It's the amount of money you would need to pay the bills if you lost your job for as long as it took you to find a new job. So for a lot of people, that's, maybe it's 6 months of living expenses. Maybe it's 12 months of living expenses. Maybe you can cut your expenses by so much that, if you lost your job, you would get really, really lean on your budget. And so you don't need as much set aside in cash. And the other piece of the puzzle, so there is this risk mitigation piece, and there's also out of crisis comes opportunity. If you want to be a person that is buying into a downturn, then that money, or sometimes we call it dry powder, right, needs to come from somewhere, right? So is it money you've already set aside that you will not need in the short term? So excess savings. Is it a little bit extra out of your paycheck that you don't spend every month that maybe goes into your 401k or your IRA or a brokerage account? But it's okay, it's focusing on cash. There's lots of potential sources, right? Savings, gifts, things like that. And I would say another piece, we definitely have a video on the YouTube channel about using your home equity. If you live in Austin, and you have a lot of equity in your house, you might want to at least consider getting a home equity line of credit so that if you need to, you could tap the equity in your house, either for an emergency or to be really opportunistic or to do whatever, right? Or to be a safety blanket. That's another kind of tool in the toolbox that's not investment related. And then the other thing you can do is work on your credit score. If you haven't bought that house yet, or if you want to get better rates on your loans in the future, work on your credit score, right? You can Google it, you can find out, the ways to improve your credit score, but access to cheap credit ends up being a really important tool for your toolbox. If you don't have access to it yet, it can be life-changing. Like, just talk to the people who have used those 0% credit card offers in order to do something or change jobs or refinance loans or something. Once you have access to cheap credit, your cost of borrowing, it can go down really quickly. So that's another thing that you can do that, again, is not investment related, but can still be really important. I have started investing journal in here. Just like write down whatever, right? It doesn't necessarily have to be like all investment related. It can be your feelings, the things that you're hoping to achieve, the things that you're afraid of. If you make a change to your account, you can write down why you're doing it. Kind of makes you accountable to yourself. If you write down in your journal, I am just so scared. I sold $10,000 out of my 401k to just make myself feel better. Write it down, right? Because then you'll be able to look back and see, how did that work out for you? I always like to cut out articles and tape them in. Make a note when you make a mistake, because it's okay to make mistakes. The whole point is that this is a learning process. And since we're going to be going through those 14 bear markets, you may as well start figuring out how you react to them and seeing that what you can do better the next time. It's probably not too late for this yet. A lot of people also start wish lists of stocks that they would definitely buy if they fell by another 20%, right? So you might have some favorite stocks that you're like, I want to own this forever. If it falls by 20% from here, I'm definitely going to buy and just go for it. This is actually a copy of my investment journal from 2008, 2009 that I made. And so I just have it's just all kind of thrown together, right? Reminders to myself, just little like notes on what happened on October 10th, right? So the Dow broke 8,000 today. Do you guys know where the Dow is today? Does anyone want to guess? You can unmute yourself and guess or maybe you know. In my journal, it was 8,000. Any guess? Anybody? All right, I'll just tell you, it's at 33,478. And here it had broke below 8,000 in either 2008 or 2009. I wrote down Warren Buffett's 3 rules of investing, right? So being able to like look back at this, I don't know, it's like, also apparently I was into garden design, right? So I have that in there too. So it's not meant to be perfect, and it's not meant to be for anyone except for me. But it's really helpful to look back and see what I've learned and how I was thinking at that point in time during a real crisis, right? 2008, 2009. Okay, so now the next one, evaluating your holdings with fresh eyes. So you can just take a look at all of your holdings and see if there are things that have the reason for owning them has changed, right? If you have like a portfolio of index funds, this probably won't be as exciting. But if you have a portfolio that has like some individual stocks or maybe some asset class that is especially tumultuous at this point in time, that maybe, your viewpoint has changed, you can go back and look at it and say, do I have a good reason to own all of these things that I own? If I don't have a good reason, or if that reason has changed, do I want to cash out of this thing and buy something that I think will be better, right? You can think through a worst case scenario for each asset class. Like, will you be able to hold them during hard times? It's important to know, like right here where we are in the stock market today, I've been telling people, and I'll tell you guys, I think there's probably like a 50-50 chance that things get way worse before they get better, right? 50-50 is like not insignificant, right? So, okay, if you are in a stock fund and it falls by another 25%, let's say, and will you be able to hold it through that hard time to get back through to the uptime? It's good to know that in advance. And do your holdings match your risk tolerance? If you are very, very conservative, I know that bear markets are painful, and they might be too painful. If you're losing sleep, you need to talk to someone. There's a big difference between being 100% stocks and being 0% stocks. There's lots of room in the middle. And most people can get to the right balance. The last thing to think about now and before the end of the year is something called tax loss harvesting. This is when so it's not for your retirement accounts. It's only for like your individual brokerage account or your joint brokerage account. But if you have stocks or crypto or funds or whatever that are now worth less than what you paid for them, you have an unrealized loss. If you sell that investment, then you realize the loss, and you can use that loss to either offset gains in other investments this year, offset gains in future investments in future years, or you can offset up to $3,000 of your income each year. So that loss becomes valuable. I will say that once you sell something, right, let's say you have an S&P 500 fund that you bought at the beginning of the year, now it's 18% down. If you sell that S&P 500 fund, unless you want your portfolio to get way more conservative, you want to use the proceeds of that fund to buy another stock fund. You can't buy the same fund back, and it can't be substantially similar. It has to be slightly different. And you might want to Google wash sale rules. You can't have purchased or sold anything within the 30 days before or after harvesting a loss. But it's a way to take losses that might be in your brokerage accounts and turn them into something valuable. So if that is something that applies to you, look up tax loss harvesting. You could ask your tax prep person, look up tax loss harvesting and wash sale rules, and think about whether that's something you want to do before the end of the year. And if we have time, we can come back and talk about that more at the end. Okay, revisiting your asset allocation is another one. This comes back to making sure that your portfolio is relatively in line with your risk tolerance. Everyone has to figure out what percentage of stocks makes the most sense for them, right? Stocks have a higher expected return over time. Bonds have lower expected returns over time. Cash has the lowest expected return over time. But stocks have greater downside risk, as we've seen this year. So the two questions to ask is, okay, when do I need the money? Do I have many, many years before I'm going to use this money for retirement, or while I'm in retirement, something like that? And what is the maximum decline I could withstand, right? For some people, it's 10% or 20% or 50% or 80%, right? That is all very specific to the person and how much risk they're willing to take in order to get what they think the payoff will be in the future. So you can change your pie, right? You could change it if you're, let's say if you're 60% stocks now and you're like, you know what, like, I'm going to buy a few more stocks. You could change that 60% to 65 or 70%. Or if you are, 95% stocks and you're like, I can't sleep at night, I'm getting an ulcer, then you can sell some of those stocks and bring that allocation down a little bit to give yourself a break. Hopefully your allocation is pretty good though so far. Hopefully we're not in super panic mode as of now. But if you are feeling panicky, it's kind of gut check time. Risk versus expected return by asset class. This just goes back to like, what do we expect to happen based on what we invest in? Our cash is down here. So sorry, on the y-axis, up and down, is our compound annual returns. So those are the returns we expect every year when we invest in this asset class. The x-axis across the bottom is the standard deviation of annual returns. So in investing, that's one of our measures of volatility. It means like what is your annual return or your yearly return versus what you expected it to be. So down here in the bottom left-hand corner, we have cash and bonds. Those are relatively low risk, relatively low return asset classes. And this is data from 1995 to 2020. I wish I had an updated one. This will look a little bit different. We updated through 2022. But the principles still hold and expect to hold in the future. Over here in the upper right-hand corner, we have large US stocks. So that's the S&P 500, small US stocks, that's the Russell 2000, and commercial real estate. So you can see out here, if you're investing in those asset classes, you're taking a lot of risk. And by that, I mean your annual returns will go up and down by something like 10% plus 20% or 10% minus 20% from year to year. So your range of outcomes from year to year is really, really wide. You have to be able to withstand that in order to invest in those asset classes. You're never going to get 10%. Some years you're going to get negative 20 or negative 30%. Some years you're going to get positive 30%, but you're almost never going to get like actually 10%. You're going to get this wild range of outcomes as it's trending upward over long periods of time. So that's what I mean by like choosing what you can withstand as far as declines, especially is what we're all mainly concerned about. How much of a decline can I withstand and for what period of time? Here's 2022 to date. The blue line is just a generic bond fund. Bonds have been horrible this year as interest rates have gone up really fast. They do seem to be stabilizing a little bit. Fingers crossed. That would be really helpful if bonds would stabilize. So bonds, which are typically a very safe asset class that we typically see, like maybe they're up 5%, maybe they're down 5%, are down almost 15% so far this year, which has been brutal for more conservative investors. The S&P 500 is the green line. So we can see it as of now that we're just under 17-ish% down this year. And then the NASDAQ is like the tech heavy part of the stock market. And the NASDAQ, it's just been brutal this year, right? So the NASDAQ is still down almost 30%, 28.5% so far year to date. But let's see. This is 2006 to date, right? So our blue line here is bonds. Relatively safe. If you're kind of collecting some income, it's relatively stable pretty much until this year. Steady Eddie. And the stock market, if you started in 2006, things were looking fine. And then you hit the financial crisis. The stock market fell by over 50%. You kind of fought your way back to even. Maybe you made it all the way to January of 2022. All-time highs of 4,800 on the S&P, and it's since come down. And through all of that, if you held from 2006 until today, you'd be up over 177% versus the actual decline at this point that you would have gotten from playing it safe in something like bonds. So this, again, is like, why are we investing in the things we're investing in? If you need your money to grow, it's going to have to be in something where you're taking risk. You're taking a calculated risk. Like, okay, I would like to double my money. What gives us a chance to do that during our lifetimes. For most people, it's stocks. Maybe real estate if you're really good at real estate. But for most people, it's stocks, not bonds, not cash. And so if we go all the way back to 1950, I mean, there's lots of bear markets, corrections, crashes since 1950. The S&P 500 started at 17.22 at the beginning of 1950. As of, I think this was today or yesterday, the S&P closed at 39.38. So over those 72 years, that's an average of 7.8% per year. Plus you would have gotten dividends on top of that. So that's where we get that 10% expected annual rate of return over very long periods of time. I just have a couple more slides and then we'll have time for Q&A and to go back to any slides that are interesting. There's this idea of like buying dips and selling rallies that sometimes appeals to people. I mean, I will say that if you kind of are in it for the long term, you can just, buy investments and just hang on to them and not really worry about things until you get to the point where you have to start selling in order to pay the bills in retirement. So there is no need to have anything fancier than kind of a buy and hold strategy. But if you do want to either take advantage of dips or maybe protect yourself in some way from potential downside, you might want to consider buying dips or selling rallies as we go through this choppiness. So I would say consider buying the dips. This means like putting more money in when the market falls or when it crashes, right? If you are early to mid-career and you have extra money to set aside, if you are really risk tolerant, if you are very patient, meaning you have lots of time and are willing to give the stock market a lot of time to generate higher returns. If you're a bargain hunter, like I always run into people like in this group or just kind of out in the world who are like, oh, I love buying things on sale, right? If you can buy the US stock market for 20% less than you could have bought it, 11 months ago, then a lot of people like, their ears perk up at that. So that appeals to a certain type of person. If you're a long-term investor, this comes back to the patience. Like, how long do you have until you need this money that you are setting aside in your investments? Is it 10 years, 20 years, 30 years? Like, if you have decades, then I think it's a no-brainer. And I will say, like, the long-term investor piece too, I think one of the misconceptions that people have is that when you hit age 65 and retire, that you take all of the money that you have and you turn it into cash and you live off the cash. That is not how people do it. When you need that nest egg to last your entire life, right? So if your plan is to get to 65 and retire and live another 1 or 2 or 3 decades, hopefully, you still need that money to grow to keep pace with inflation, right? That's a really, really long time. So there might be a period of time around retirement where you're a little bit more conservative on the front end of retirement and a little bit more conservative as you go through like the retirement transition and figure out how much it actually costs on the other side. But you can still be a long-term investor when you're retired. You should be a long-term investor when you're retired. That's what we're all hoping for, I think. And the other people who can kind of think about buying the dips are people who are focused on growth, right? Like, okay, I need this money to grow as fast as possible. That means being more aggressive when you can buy at lower prices. On the flip side, consider selling the rallies if you are maybe late career, risk averse. If you kind of got caught in this bear market and you were like, this is not for me at all, then it probably is time to figure out what the next piece of the plan is. Or if you're really nervous and that, it doesn't matter how old you are, young people can be very nervous about the stock market too. Stock market investing is not necessarily for everyone, but you do need to get a plan together so that you end up with enough when you get ready for retirement. If you're anticipating a major transition, this comes back to that retirement example. Do you have a kid going to college in the next couple of years? Are you, going to have a kid and maybe be out of work for a while? Are you going to get divorced, right? Like if there's a major transition, you probably want to consider building up something, either cash or something relatively safe to get through that transition time. And then some people just think that a bird in the hand is worth two in the bush, right? They'd rather have what something is worth today versus putting at risk for something in the future. It's really tricky to kind of be an investor. You have to be really picky about your investments, but you also have to be out actively looking for investments that kind of satisfy that kind of risk averse behavior there. And then after all of this, like you do all of this work and you think about all of these things, and then you just have to let it go. And you just have to let the markets do their thing if you're going to participate. So there are things you can control, right? Your budget to a large extent, your spending choices, your savings rate, some of the taxes you pay. We talked about tax loss harvesting, things like that. How much money do you put in retirement accounts, debt repayment, career choices, risk tolerance, your behavior. Those are things you can control. And then there are things you cannot control, right? The stock market. You cannot control the stock market. You can't predict it. Bond market, same thing. Interest rates, no way. Inflation, who knows? Politics, nope. Global trade, have no idea. Tax rates, no one knows what those are going to be, right? So I think like in, financial media or in the financial world, there is this people want to give you the impression that you can know enough or pay someone who knows enough to help you predict all of those things on the right. And you cannot, they are not in your control. Things on the left are in your control, but the stock market, the bond market, interest rate market, all of those things are so complex that they can't be predicted. So that's really important to just come to just make peace with it. All right, so now we have time for questions, and I'm happy to open up the floor for people who have questions, if they're related to the stock market, I can help answer them. If there's things that are more appropriate for the group or something that you want to get feedback from the group on, we can do that too. We can just kind of open up the floor and see what happens.
Hi, Sarah. I think Isabel had a question about one of your charts. She was asking, what are dips?
Oh, dips. Yeah, so the idea of buying the dips, if we go back here, let's see if I can go back to a chart that shows what I'm talking about. And I guess that I should have been that's like a term that, I don't know, it's a term. It's one of those terms that we throw around. It's the idea of on this chart that when the market falls, can you guys see my cursor when I'm moving it around? Can you see my arrow?
Yes.
Yeah. Okay. So when the market falls, the idea of buying the dips is when the market falls, you kind of almost automatically add more money to your stocks. Right. So there's this idea okay, if you're always buying the dips, you're putting extra money in whenever the market falls. Right. That works really, really well when the market falls and then bounces back right away. Right. So most of the time here, if we're looking at this chart, we can see, okay, at the end of 2018, that resolved itself pretty quickly. Even March of 2020, that was a pretty major dip that resolved itself pretty quickly. But when you're buying the dips into an extended bear market, it kind of turns into feeling like you're flushing money down the toilet. Why would I keep putting money into the stock market if it just keeps falling? But the concept is that if you believe in the long-term trajectory of the stock market, that every dip is a buying opportunity eventually. You don't know when it's going to turn into a buying opportunity because you don't know when the price is going to recover and eventually be higher than what you paid. But that's what the idea of buying the dips is. And on the other side, selling the rallies is, okay, every time the market gets high enough, and you have to figure out what a dip means to you and what a rally means to you. Once the market gets high enough, I'm going to sell some and take some profits and put it aside in something safer. It's really, really difficult. I mean, you can't time the bottom or the top. So it's more of a way of thinking about how do I get more money into stocks or how do I get money out of stocks, depending on what direction you're going. Did that answer that question? Buying the dips? What else?
Okay, we got a question. Is there a certain type of person or investor who wins when things are so uncertain?
Oh, that's a really good question.
Good question, yeah.
Yeah. I mean, I don't know. I mean, in every market environment, someone is winning and probably gloating and talking about how smart they are and how stupid everyone else is, right? So in 2022, that is people who have been big investors in energy, right? So energy has just been like on fire, right? Like up 40%, all the rest of the market is down 20%, just like massive outperformance. So people who hung in there with energy through, I mean, you guys, 6 years ago, ExxonMobil was at about $100 per share. It fell to $30 per share and is now back above 100. And yet, energy investors are taking a victory lap this year. I'm like, y'all, you were down 70% 2 years ago. So don't take the victory lap. But like every market has winners and losers. And most of the time, like, you know, the markets, everything is kind of ebbing and flowing at some point in time. There aren't really a lot of people who can navigate every market environment well, right? There are certain strategies that work well when the market is going up and they're horrible when the market's going down. So for a lot of us, like we would be called, most individual investors are long only investors. That means that you just own things. You own things that you expect to go up over time, right? The opposite of being long is being short. So I don't know if you guys read The Big Short by Michael Lewis or saw the movie. Being short means you're making a bet that the price of something is going to go down. So short sellers have done well this year because the price of things have gone down. But you can't make money as a short seller when the market's going up. It's really difficult, right? So this year, it's energy and short sellers, or people who can switch from long to short based on where they are predicting the market is going. But that is so incredibly difficult that it's nearly impossible for a person or a firm to consistently do well over time through all market environments. And most of us are just kind of like, well, sometimes the market's going to go up, sometimes it's going to go down, but over the long run, it's going to go up. I can just wait and live my life until that happens, instead of trying to figure out from day to day or month to month or year to year where the market's going to go and try to get in front of it. But that like trend following strategy is really, really difficult. A lot of people lose a lot of money doing that. So I don't know if that answered your question, but
it's only
someone's
Sarah.
always winning.
It's only Sarah.
Hey.
That was my question. Hi.
Hi.
No, that's helpful. You hear people who like short the market, like they know everything that's going on. And real estate, one of my takeaways in the last 6 months has been that everybody in some ways is losing money. Right.
Yeah.
It's all of us. It's not just like some of us. We didn't make bad decisions. It's just that's the way things are right now.
Yeah.
But
I love that. Keep going.
Yeah, you do hear that some people like knew what they were doing. And in some ways they're probably just lucky, or they're just in the minutia every day.
Yeah, I mean, I love that because I think that is a really common sentiment. It's like this, like, I'm doing it wrong, right? Like, if this happened to me, if my accounts are down, I did it wrong, right? And that is absolutely not the case at all. Everybody, I would say, even those short sellers, or even like maybe there's like a few lucky people who went to cash on January 3rd and are now taking their victory lap, right? Like, those are not, like, we're all in this together. Most of us are long only investors who are in it for the long run. And we're also not the people like on Twitter or, trying to do like a paid course on trading or like trying to make money off of this. Like we're all just kind of struggling through bad markets together. And again, like, it's normal. So it feels very bad, but it is totally normal for this to happen, and it's going to happen again. And if you imagine like the person, like I imagine like the siren song, like of the going to cash, like imagine like if you had decided in January to go to cash, and now like you're super excited, and then you figure that you can buy the dip at the right time. What's going to happen the next time the market goes to all-time highs? Are you going to be, I don't like, are you going to feel like you're going to go to cash again? Is this like your strategy where you're just going to go to cash and then get back in and then go to cash and then get back in, and your whole strategy is jumping in and out of the markets? Like, I am 99.9% sure that if that's your strategy, it is not going to work. You might get lucky one time and you cannot duplicate it, right? There are people who've been trying to become like the next hero of the Big Short book, right? Big Short 2, like for years, right? Like there's always people trying to do that and trying to outsmart everybody else. And I would say that that is like, don't go down that path. Like, it's a recipe for sitting in cash on the sidelines for like half of a bull market, right? Like missing a bunch of the upside and then being like, oh, I guess I can't afford to stay out of the market anymore, just in time to get back in for the downside, right? It's like you might be able to do it once effectively, but it is like really, really hard to do it more than once, I would say. I think it's way more luck than it is skill. I showed you guys just those two recession indicators that are two really well-known recession indicators, right? GDP now versus LEI. Like, there are millions of indicators that would tell you to get in and out of the market. And which one do you choose, and which one is accurate, and which one is accurate every time? Like, none of them are. So it's really tricky when you're an investor and you're out there and you're like, oh, I'm down 30% this year, right? Like, oh, I sure wish I could go back in time and make different choices, but that's just the way that markets work. And they recover, right? They recover if you're in broadly diversified stocks. The stock market will recover. If you're in real estate, like, real estate recovers over time, right? Like, all of those things. If in the United States, if we continue to be a democracy that's focused on capitalism and incentivizing people to create businesses and goods and services that people can buy, as long as we continue along that path, then our economy is going to grow and the markets are going to recover. It doesn't mean it's not painful when it doesn't work out that way in the short term. But I don't know. I think it's the truth, right? And so I think investing in the US is a really good place to be. And that, like one of Warren Buffett's like kind of one of the things he always talks about is like, never bet against the US, right? Like, and don't bet against US stocks. Like, most of the time they go up. Don't get discouraged, just hang in there. And he's been doing it for what, like 85 years. I think he's 92 now. He started when he was 14, right? He's done pretty well for himself. Really good question.
Answer, Sarah.
Okay, Azucena has a question about tax loss harvesting. If you're in it for the long haul, does it make sense to tax loss harvest? Or when or why does it make sense to do it? Sell at a loss, counter the gains, etc.
Yeah. I mean, it's if you're trying to pick up a little bit extra from the tax savings. So if you're in it for the long run, and if you have been an investor for the long run, you might not have that many losses to harvest. Right? Like I was just looking at an account today where like there's this, it was just an S&P 500 fund that this person owned for, something like 3 years, right? Maybe 4 years. And like the gain was still, she's still positive in it, right? So like that's even like a relatively short period of time. She still had a gain. There was no harvesting to be had. But I would say like if there's new money that you put into an individual account or a joint account, like in the last year, maybe 2 years, it's worth it to look to see if you could pretty easily swap this stock fund for that stock fund, take the loss, and offset $3,000 of your income, depending on what income tax bracket you're in. So let's say if it's 3,000, let's say if you're in the 24% tax bracket, so that whole thing would save you $720, right? If you got to exclude $3,000 of your income from paying taxes, it would save you $720. If you had another gain, if you were like selling a house, like an investment property, and wanted to offset some of your gain, then maybe that too would make sense. So go ahead.
Yeah, no, that's actually pretty helpful, Sarah. Thank you. Because that individual stock or fund, that makes sense to me, actually. That's actually the exact example I have right now. So I was thinking about it as you were pointing it out, maybe calculating what that would be. If it's $700, I'm like, maybe I would do it.
Yeah, it'll probably take you like 5 minutes, maybe 30 minutes if you have to research. Because you want to sell the thing and then you want to buy the same amount of a different thing, assuming that it's a long-term investment and you don't want to miss out on a rebound, right?
Right.
So it takes a little bit of time to do that, but for $720, that's a pretty good hourly rate, right?
Yeah.
If you had a $6,000 loss, you could use $3,000 this year and another $3,000 next year.
Mm-hmm.
So that's kind of where it's like, okay, well, how much time is it going to take you? Like, if you have time between now and the end of the year, I don't know. I think it's like a pretty good way to kind of turn lemons into lemonade in a situation like this, right?
Yeah.
When you get something out of it, right? out of those losses.
I know. Other than just looking at them and, wondering what happened. So
why did I do this?
Yeah.
Right.
Okay. Well, thank you so much. That was very helpful.
Yeah, good. 12 more minutes. What else you guys got?
I know one thing we wanted to talk about is what people think about what to do for our December meeting.
Oh, maybe let's talk about that really quick.
Maybe now's a good time to talk about it.
Yeah, Lori, do you want to kind of describe what we're contemplating?
So, as you guys know, we've been meeting via Zoom for a long time, which is good because you can do it all the time and people from other cities can join us. But we were wondering, is now the right time for us to have maybe our December meeting be a local meetup where we all get together? And so I was just wondering, what do you guys think?
I'm always saying for in person. So I'll put my vote for the yay in person. Let's see, my camera is not working. 1 second.
Okay. Well, yeah, thanks for saying something. It looks like Ole said she would like to meet in person too.
Yeah, this is Lauren. I'd like to meet in person as well.
Okay.
Cool. Maybe we can send a survey out to the group too, just to maybe gauge interest, because like as I'm, I know Lori, as we were talking about it, we were trying to figure out like, okay, well, how, like, do we need a small venue? Do we need a large venue? Like, is everybody going to come? Like, are all like 3,000 members going to come, or are we going to have like 10 people?
I mean, can you guys do a local meeting where you also kind of hook in people from Zoom?
Oh, we probably could figure out how to do that. That'd be cool. Isabella, we don't quite know when it will be. It would be we're thinking for December. Like in the past, we've done an end of year meeting where it's a little bit more fun and a little bit more social, right? We usually have like some, like share a piece of investing advice, or, what could if you could tell yourself something, 20 years ago, what would you tell yourself? Something like that, like to have some like kind of investing component to it, but it's typically just a way for us to celebrate the end of the year and do a potluck, or like have everyone bring cookies or goodies or chili or whatever. So we obviously haven't done it in a while, so yeah, maybe a hybrid option would be a good idea if we could figure out how to do that. I missed you guys in real life.
Okay, well, thanks for your input. Yeah, if we do it, Isabel, I see you. Yeah, you have to travel, so you'd miss it. We'd have to see what we could do for a hybrid option. Yeah, it would be nice to see each other in person. How do you guys feel about meeting outdoors versus meeting indoors? Do you have any issues meeting indoors? Do you feel like now's the time we can meet indoors, or do you feel like you still want to meet outdoors? Okay.
I'm okay indoors, but open to either. I'll just bundle up for the outdoor if it's more convenient for everyone.
Yeah, I'm the same. Either way.
Okay.
Cool.
And if you do it, happy to help in any way, bring something, or, volunteer to, I don't know, clean before or afterwards.
Oh, great. Thank you. Yeah, it'll probably take a village, right? Because we haven't done it in a while. Yeah, I think we would have some sort of protocols probably, right, in place. We are still at the ideation stage, so I think we also are not totally sure what availability looks like in Austin these days too for a group. I mean, I think we used to count on 50 people showing up to an in-person meeting kind of before all of this, right? And so that's a lot of people. And so I think we'll have to figure out what we have available as far as venues. So if anyone has any ideas, please shoot them our way, or we will probably check out the libraries and places like that too, because that's always been like a nice fit for, and we can usually bring food, and they have AV equipment and stuff like that. But yeah, well, we will keep you all kind of updated, and maybe we'll send out a survey too to the larger group. But it's really helpful to just kind of take the pulse of the group and see what people are thinking for this year.
Yeah, thanks for giving your opinions.
Cool. Well, if no one has any other questions, then we can wrap this meeting up. Good luck out there in the investing world. Hang in there. If you need, I don't know, emotional support, definitely let us know, or like join us on the Facebook group and just post something like Ollie said, like we are all in it together, right? And I think we all have probably different feelings. Like some people are kind of take it in stride, and some other people like have a really long-term perspective. Some people know what it's like to go through a bear market for the first time and can totally, commiserate with you. And so whatever your feelings are, I think it's helpful for people in the group to know. So thank you everyone for sharing today and for joining.
Thank you.
Right.
Thanks, everyone. Have a good evening.
All right. Happy Thanksgiving, everybody.
Happy Thanksgiving.
See you soon.